Everyone talks about trading with the trend. Trend is your friend, but they don't tell you how to actually take trades when you are trading with the trend. Because let's be honest here, the market structure doesn't look like this. Okay, a lot of people would teach you that this is what the market structure looks like, but in reality, it's completely different from this. Okay, and yes, of course, if you could make money with only trading with the trend, for example, you would buy here, right? It would be all sunshine and rainbows. You would buy here, break of structure, pullback. You take your entry, you make money. Every single person would be a billionaire, all right? So, trading is a hottest way to make easy money. But if you don't know what you're doing on the markets, right, you're gonna get wrecked most of the time. And you have to completely change your perspective about how the markets move. Because we are taught that the markets move in this manner, where you have a higher high, higher low, higher high, higher low, higher high, higher low. You take your entry from auto blocks or demand or supply zone, right? But this is the complete opposite. So in this video, I'm going to teach you the best entry model that you can use with the trend. And this entry model is going to change your trading forever. And it is going to 20x your returns. And I'm not even kidding here. So make sure you watch till the end, because I'm going to give away a lot of sauce in this video. And I'm also going to show you multiple examples so you guys can understand it correctly. Okay, so this model can work on one time frame, so you don't even need multiple time frames. It really works on one time frame, and this could be above 5 minutes. So I wouldn't recommend going below 5 minutes, because I traded only on 5 minutes and above. So what really is the model, right? So first thing first, you have to identify the order flow, right? So where are we going, right? What is the direction of the market? And you can basically identify this if you open up a pair, and within 3 seconds, you should be able to identify the direction of the market. You should know where the market is going. If you get confused and you start questioning, are we going up or are we going down? Are we consolidating? That is when you move on to another pair, because the market direction is not clear. It has to be 100% clear, all right? That's when you trade with the trend. And I'm going to teach you the entry model that you need to use in order to stop getting faked out. It is very simple. So very first step is that we have to identify the direction of the market. The second step is identifying that if you are in a kill zone or not, because this is very important. Your entry must be during kill zone hours. So let's say, so this is the entire entry model, all right? And let's say that we are trading with the trend. The trend is bullish. So what you have to do is wait for a higher high, higher low, and then a higher high formation, okay? Now, a lot of people would tell you that when we have a break of structure here, right, you should be taking your entry from a fair value gap here or an auto block. But most of the time, what's gonna happen is price gonna push down, give you a small reaction, and then it's gonna push down. Now, when this happens, right, what you think, oh, this is a change of character, or this is a market structure shift, right? Because we had a higher high, higher low, higher high, and then we got a market structure shift. But what happens then next is that people have their short positions, limit orders over here, and they're expecting that when price comes back into this fair value gap, it's going to go down. But what happens? Price gives you a small reaction, and then it continues in that direction. So this is where a lot of people fail. This is the only bottleneck that is holding you back from becoming a consistently profitable trader. And I'm going to teach you exactly how to avoid this mistake. So when you have identified the trend, when you have identified the market direction, what you are simply doing is waiting for price to sweep out this low. So this specific low, right after this low was formed, that's when price pushed up and broke this structure. So you want to mark out the low that caused the break of structure, okay, or a market structure break. Now what you're doing is simply waiting for price to come back and sweep out this low over here. Now what you also want to keep in mind is, let's say there is a fair value gap here or an auto block here, that is a plus point, okay? When price sweeps out this liquidity and taps into this auto block, right, that is a plus point, but there could be no PD array here. It doesn't matter, all right? Now, here's the entry model. How do you take a trade when you have a liquidity sweep? Now, when the order flow is bullish, and if the price wants to go up, what you want to do is from this dealing range high to this dealing range low, you have to identify fair value gap or multiple fair value gaps. So let's just say that there is one fair value gap over here. Okay, now the next step is that we have to wait for price to inverse that fair value gap. So what you are waiting for is to price to close above it. Okay, now I want to see some form of momentum. Okay, I want to see some form of like eagerness for price to go up. Okay, if price kind of consolidates inside this fair value gap, you know, like that, and then it inverses, then that is not good. We want to see a sharp push to the upside. That tells us, okay, price wants to go up from here. Now, once you have your inversion, what you are simply doing is taking a long position, guys. You're simply taking an entry right here. You're putting your stop right below the bodies of the candles. So this is the low, and you want to put your stop below the bodies of the candles, okay? And then you can essentially just target this high over here. So we are taking continuation trades, all right? Now this is a continuation purge, okay? This is what I call it, the continuation purge. When a trend wants to continue, it has to seek some form of liquidity, all right? It can't just keep going up like that. The way you're taught by a lot of gurus that price is going to keep on going up like that. It needs some form of liquidity, all right? And you want to wait for price to sweep out this low over here, potentially also tap into some form of key level. Now, once you have inversion, you take your entry, and I promise you most of the time, price is going to just rush up like that with high velocity. Okay, now what if there are multiple fair value gaps from this dealing range high to this dealing range low? It is very simple. What you have to do is wait for all of them to get inversed. So let's say there is a fair value gap over here as well. So we have two fair value gaps inside this dealing range from this low to this high. Okay, so you are simply just waiting for price to close above both of them, and then you can take your entry. Now, there are some key rules that you need to understand, or this model will not work. This entry model will not work, okay? So very first step, your break-even zone is gonna be this high. Why? Because it is the closest liquidity pool to your entry. Okay, the closest high or low to your entry is when you should go break even. Now, if that closest liquidity pool is hit before your entry, then the setup becomes invalid. The goal here is that we need to get into the trade before market structure shift, okay? And that's how we mitigate the losses. That's how we avoid the losses. Because what can simply happen is price can reverse from here, all right? We never know. We are just trying to react. We are not trying to predict. We're trying to react what the market presents to us, all right? So this is the best risk management that you can basically see, all right? You're playing it safe, and you're basically waiting for a home run towards this high over here. So when you take your entry here, right? Let's say you take an entry here. You put your stop somewhere around here. You want to go break even. Now, this is a very small, and you know, a lot of people have brainwashed you to thinking that you should go break even at 1 to 1 or 1 to 1.5. But you want to think about these markets logically. If this liquidity pool is hit, there's a very high chance that price can reverse. There's a chance, okay? There's always a chance, because you never know from where price can reverse. You're only trying to react, and you're trying to scalp out the profits from these markets. So when this level is hit, you go break even. You can basically take one partial at 1 to 1, and then you can hold towards this high over here. Very simple stuff, guys. Very, very easy model that you can trade. This is the best, probably the best entry model that you can trade with the trend. Number one, you are getting in as soon as possible. So right after the inversion, you're taking a trade. You're not looking for a market structure shift. You're not looking for a change in a state of delivery. You're simply taking your trade after a market structure shift. Now here's a plus point and a key thing that you can use to increase your win rate. So when you have a liquidity sweep, you can basically look for SMT with the correlating asset or pair. So let's say that this is Euro USD, right? So on Euro USD, we made a lower low. So we swept out this low, but on GBP USD, we failed to do so. So we didn't sweep out that low, right? Now that is your SMT. So that's gonna basically help increase the win rate. Now that we know, and also let's invert the chart. This is what it's gonna look like. Exactly the same for short positions, right? We have a downtrend. We sweep out this high, right? This high caused a break of structure, this specific high. We get a sweep here, we get inversion, and we take our entry. We go break even here, and then we target this level. And of course, with SMT, your win rate is going to increase. Now that we have understood the entry model, I'm going to give you guys some examples so you guys can understand properly. All right, so here is example number one. I'm looking at gold on the 5-minute time frame, and you can clearly see that the market was pushing up, all right? I didn't have to second guess. I knew that the market is going up without any second guessing. Now, what you can see, we have to look at the market structure. So we have a higher high, we broke the structure, right? And then, yes, of course, we got a continuation purge, but there was no inversion here. There was no fair value gap, all right? But then look closely, we broke above this high again, okay? And specifically, if you look about this here, you can also see that we have, yeah. So this low over here is what caused the break of structure to the upside, right? So now what we are looking for is a sweep of that low. Now that is step number one. Now below it, what you can also see is that we have a fair value gap resting around this level on the 5-minute time frame. Now what you see is that from this dealing range high to this dealing range low, what we have is a fair value gap. So what we do is we mark that out and we wait for inversion. And right after the candle closes above this, what we are doing is we're taking our entry, putting our stops below here, and we can target these highs over here. We can go for 1 to 2 here very easily. Now you can also see is that this closest draw on liquidity was not hit before our entry, and that's why the entry was valid for us. Okay, so the very key thing that we are doing basically here is identifying a clean trend, a clean momentum, and then we're waiting for a continuation purge that happens over here, right? So basically this is what we're looking for, right? High, 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 low, high, high, and then sweep off that level. Potentially tap into some form of PD array. That's not necessary. But then afterwards, what we have is an inversion. Now also keep in note that we took this trade, we would have taken this trade during the New York session, so kill zone point as well. We must be trading during the kill zone if we are below 4-hour time frame. So this was the example one, very clean setup. You can see how beautifully price distributed to the upside. Now let's move on to the another example. All right, so here's example 2. All right, so the trend, there's a very high chance the trend will reverse after we get a Judas swing of London high or Asia high. Okay, so you have to be very careful here. Now you have to watch my other videos on how to identify Judas swings. But basically, when you get a Judas swing of London high and you get like a sharp market structure shift like that, that means that the trend has reversed. Okay, because after, let's say, so this is a very secret sauce that I'm giving you right now. So if Asia session expands, London is going to consolidate, and then New York session is going to manipulate and then expand. Very simple stuff. So in this case, we had a Judas swing, right? And when we were pushing down like that on the 5-minute, you could have known that, okay, we're going to go down from here, okay? Potentially towards this Asia low over here. Since we're on the 5-minute, right, that's how we have to look at the markets. Now you can see we have a lower low. We have a lower low, lower high, and then a lower low. Now this high specifically pushed the price down for a break of structure or a market structure break, however you want to call that term. Now what we're doing is waiting for price to sweep out that high. So that is going to be a continuation purge right there. Now I don't want to see price break out of it and then keep going up, okay? That's going to be invalid. I want to see like a quick reaction to the downside. Now also from this dealing range low to this dealing range high, what we have is a fair value gap right here. Very clean stuff. Also, we are taking this trade during kill zone hours. So this would have been your entry. And look at that beautiful move. Your stop loss goes above the bodies of these candles, not above the high, because if price reaches there, there's a very high chance that it will take out the highs anyway. So it's just best to keep it here. And then you can see, guys, absolutely beautiful. You could have targeted probably this low over here with 1 to 2.5. All right, so absolutely beautiful. All right, guys, so here is another example, but this time on the higher time frame. So we're looking at the 4-hour time frame. We're kind of pushing up here, so that would give you an idea that the trend is going towards the upside. Now over here, you can see we have a higher high, higher low, and then a higher high, right? And we also have left behind this low over here. That is a significant low that caused the price to break the structure, right? Now we do also have a wick above this level, right? So we have this low, and we also have this low as well. Now, once we get a sweep of this low, preferably, what we're looking for is inversion, right? So look from this dealing range high to this dealing range low. Where are the fair value gaps? So we have one over here, small one, and this is like the final one, right? So we're gonna mark all of them out like that. And once price inverses above it, that's when we take a long, right there. Put our stops right below this low, right? And pretty much you can see it played out perfectly. Let me see if I can find a couple of more examples. So I believe, let's see, I believe we got one over here. So we have a sweep over here, right? We probably closed, yeah. So we wicked above it, that's a higher high, low, and then a higher high. And then we sweep out this low over here. And do we have a fair value gap here? No, we don't. So let's see if we can find one more example. Okay, so in this case, you can see the way we had a lower low, right? Lower low, lower high, lower low. And then we swept this level, but we failed to inverse all of the fair value gaps, right? So until we reached here, and that's when we inversed it. So you can see over here, right? That would have played out as well. When we inversed all of them, that's when you would have taken your entry, stop would have gone here, and this would have given you at least 1 to 1.5. So yeah, let's see if we can find a couple of more examples. Okay, there's one over here, I believe. So we have a lower low, lower low, lower high, and then a lower low. And you can see that we have this high. So this specific high is when the downtrend started that took out this break, that did this break of structure. So then what I would be looking for is simply a inversion. So from this dealing range low to this dealing range high over here, you can see that we have two fair value gaps, one over here and one over here. So I would wait for all of them to get inversed. So right here, when you can see when we inversed it, that would have been your entry. Your stop would have gone here, right above this high, right above the inversion, right? All of the fair value gaps. And you can see that you could have targeted basically an easy swing trade towards this low over here. So that is going to be it for today's video, guys. I really hope you guys enjoyed it. Thank you for watching. And if you want to trade live with me, like I trade live every single day, so there's a link down in the description. Click on it and you will get a 7 days free trial. Come and join if you see the results. That's when you pay. Goodbye.